Welcome, everyone. My name is Barbara Shellhorn. I'm a senior client advisor with SBSB Financial Advisors. And we're here today to have a conversation about the future landscape of estate planning and gifting. So we'll spend as much time as you want discussing the topic. And as we go, if you have any questions, please feel free to post them at the question and answer section. And we'll be sure if there's some questions we didn't address, you have our email addresses, so please be sure to shoot us an email and we'll try to answer your questions. So I would like to introduce our two speakers today. First, we have Karen Wazazik. She's a principal and senior director of financial planning at SBSB. Karen has over 2 decades of experience partnering with high net worth clients on complex wealth and estate planning. Karen is also passionate about community service, especially around economic empowerment for women and families in the DC area. And we're also pleased to be joined by Lee Basha. So Lee is a partner with the law firm McDermott, Will, and Emery. Lee is also a well-known expert in domestic and international estate and tax planning. So I would like to start today with a brief story. Middle of December, I received a phone call from a client who I've been working with for over 20 years. And the phone call was rather urgent. They were very concerned that their current estate plan was out of date and they needed to make significant changes and they needed to do it immediately. Honestly, I was a little surprised because they have been diligent in creating an estate plan that reflects their goals and values, and they've been on it. Every year we talk about it and try to move forward with it. However, once I started thinking about it, I realized that all of us have been bombarded with confusing and probably conflicting messages around what might happen to the estate and income taxes. So more importantly, I think it's trying to weed through all this information and figure out what the changes are and how it impacts me and what I should do about it. So today we hope that we'll be able to unpack some of that stuff for you. So to set the stage, I'm going to turn it over to Karen so she can describe the current estate tax law.
Thank you, Barbara, and thank you all for joining us today. Yeah, I think it's important, if many of you listened to the prior session, which was on the income tax planning side, there's some intersection here. And so they kind of teed up nicely a little bit of what we're going to be talking about today. But we have right now in motion a set of estate tax rates that apply through 2025, and that's called a sunset provision. And that's current legislation. And so we're going to talk about how we deal with that today, and then also what might be changing on the horizon and how to think about your particular circumstance in light of that. So right now I'm just going to share a table just so that we have context as to what that looks like. And give me 1 second. Okay. There we go. And so you have a table here, and on the left side, I've included our region, but it is noteworthy to kind of just tuck away for you that 12 states in our country still impose some kind of estate and or inheritance tax. DC is kind of going in the wrong direction with not meeting kind of the federal estate tax exemptions. So here on this table, you'll see at the top line, the federal estate tax. And this is $11.5 million roughly, indexed for inflation, double that if you're married, and that's at a maximum rate of 40% on your taxable estate. And then you'll see layered on that, depending on the jurisdiction that you're in, could be DC, Maryland, Virginia, or any of the other states in this country. But like I said, 12 will have some form of an additional tax. And that's another 16%. So you can see very quickly the importance of planning with regard to how we need to reduce and kind of shrink that, whatever your estate tax level is. So let's say very quickly, for example, you have a $20 million estate. Are there ways to think about using and squeezing that value into an $11 million hole? And so that's what we're going to talk about today. The that I mentioned on the sunset provision with December 31st, 2025, which will be here sooner than we know, that is set to go back to 2017 levels. So that's indexed right now at around $5 to $6 million per person, and twice that if you're married. So one of the kind of silver linings of the Tax Code Jobs Act is that portability was subsequently made permanent. So while the estate tax threshold is coming down to that $5-6 million level, if you're married, you still can take advantage of that other half. And so in the thing that we want to kind of layer on and think about today during our conversation is a couple of things that might be changing. So it might be lower than under the Biden administration. There is a kind of a strong force to bring that $5 to $6 million even lower to amounts that are indexed at a $3.5 million level. And to kind of put some real meaning to that, most of us in this area live in properties and homes that are of high value alone before you even touch any of your other holdings, assets, accounts, all of that. So you can quickly get to $3 million without any growth. You layer on that and a 20-year investment growth plan, you can see very quickly that you can go from $3.5 million, that if you're looking at your balance sheet today, and this is where kind of working with your financial planner, working with your legal team, and trying to decide what that looks like for you in the future. That's the crystal ball. What do I actually have in the future? A little bit of it is about today, but largely this is a future state plan that we're trying to put together. And so if that ends up being a circumstance where with growth or inheriting other assets, you find yourself now into those really high tax rates. The other part of that, the administration's ideas, is to not only reduce the estate tax threshold from the 5 or 6 down to 3.5, but also increase that 40% rate that you saw on the table to a 45% rate. So very meaningful wealth kind of distributed in form of taxes, and not to your heirs, not to charities. And so that's what we want to talk to today, is about the effect of those new legislative changes, should they happen. The other change, and I want to get Lee's opinion on this, because some of this is, like we said, a crystal ball, and I think Dave, my colleague, said it very well in the earlier session, is you want to be aware of this, but you can't plan everything around the crystal ball. You really need to look at your particular circumstance. And we'll go through some of these examples today. But right now we also have the, what is called a step up in basis, or transferring an asset at a new value that is ideally the increased value, because it's higher when you die than when you probably bought it 20, 30, many years ago prior to that. And so the beneficiary of that particular asset has the benefit of that new higher value. So the discussion around that changing and removing the step up in basis is that could have real impacts on not just the you who's planning for your estate, but the people that receive it, and the burden of taxation on them for receiving assets that no longer benefit from that increased basis. And I think that's probably a really good time to kind of ask Lee, what do you think in terms of those future state ideas and proposals and probabilities?
Right. Well, and the session right before this was really quite excellent in hearing their looking into their crystal ball and what they were predicting. But there was the title for a recent webinar put on by the American College of Trust and Estates Council was called "The Senate Went Blue: What Are Estate Planners to Do?" So now, at the year end of 2020, the idea of with the change of administration, will there be a change in the estate tax? Should we give it all away now before the year end, just in case something becomes effective as of January 1, 2021, because retroactivity is permitted? What might happen? An interesting aspect is we actually are right now in 2 separate fiscal budget years. here in 2021 because the U.S. runs on a fiscal year. So it goes from October to September. So we're actually, that one hasn't been passed yet. So we're still in that one, plus the new one that's going to come about at the end of this year. So will we get 2 different budget reconciliation acts that address tax issues? We don't know, right? And it's also important to kind of know what is the process, the legislative process, and what is the significance of the 2 seats in Georgia in January going Democrat. Does that really impact things? Because we all know there's a lot of horse trading that goes on in Congress. And when you watch the sausage being made, what they start off with is not what you end up with at the end result oftentimes. So we really don't know. What we do know is the existing law of the exemption amount of $11,700,000 per decedent or donor is going down on January 1, 2026. So that's a given. So if nothing happens, if no horse trading is successful, we know that that's what we're dealing with. And so many clients are saying, they were doing it at the end of the year. Should we be giving it away? What if we don't really need to give it away? Is it too much to give away? Should I only give $1 million away? Is that really going to be significant? If the exemption amount's still going to be over $1 million anyway, so I really haven't accomplished anything except maybe getting appreciation and growth out of the estate. So there is some side benefits. So many postponed. And so now they're looking at it and saying, okay, do I have another chance to do the gifting? And if I should I really be concerned about retroactivity? And we all know that retroactivity of tax laws is constitutional. So yes, it can happen. It could have something passed in December of 2021 could have an effective date of a different date, right? Or the estate for income tax reasons, they could say, okay, it's effective as of January 1, 2021, let's say. For estate and gift tax, it's sort of funky there, because for estate and gift tax, the exemption amount is, what is it, not at the time for a gift, when you're making a gift, but what is it as if you had died at the end of the taxable year. Right. So if Congress changes it and makes the effective date the date of passage and doesn't even do retroactivity, and somebody made a gift in the early part of 2021, and Congress changes the law and makes it a lower gift tax rate, because the Biden proposal is to reduce not just the estate tax exemption down to 3.5, but the gift tax exemption down to 1 million, and raise the rate to 45% from the 40%. So now what does the math turn out to be? Now what do you do? And what if you've given away 11 million at the beginning of the year thinking, oh, well, it's still 11 million so far, we're good, right? And then in December, they change it to 3.5 or a $1 million exemption amount. And oh my gosh, there's gift tax due at 45% on $10.7 million. Ooh, I don't think that client's going to be very happy writing that check. And they could call to you, I need to sell stock because I need to come up with I need to come cash to pay the tax bill. So, it can be very disconcerting. So as planners, we're like, okay, well, how do we minimize your risk? How do we give you the comfort that even if that happens, Congress changes it, could you undo your gift? Is there something you could do if they don't make the effective date be January 1, 2022, and it really is effective in 2021, right? Let's just say that's the case. So we look at even if it's not retroactive, right? So what I just went over, it's not even if they do anything retroactive, the client might still have a problem, because the date of the gift happening in 2021 and the change of the law happening sometime in 2021, even if it's at the very end of 2021, based on that one reading of how you actually judge the exemption amount, it's as if you died at the end of the year. So it really is an issue. Mm-hmm. So you say, okay, well, what can we do for the client? Well, number one, we can do things where it could be undone, perhaps, right? That we look at that. We look at, well, what if we can do formula gifts so that...
Well, let's just a second on that. That's a good point, the undoing of things. Because, I've grown up in this business with the idea that You give I get a tax benefit, right? The IRS has given me an incentive to give it away, so I'm thereby reducing and now shifting that wealth down. And I've grown up with the idea that once you give it away, it's not yours anymore. You don't get to make a decision anymore. And so the common thing to Barbara's starting story is working with a handful of clients this year, and the big question was, I'm really afraid. Yes, I know that the tax is going to be worse than it is today by doing nothing. And it's okay to pay the IRS too, if that's your thing, right? So, but I think that most agree that actually I want to see others benefit from it, community or family. And what if I actually give away too much? And part of our role in doing that is, let's try to model what your personal financial and lifestyle needs are. Put something in place. But to your point, once we've drafted and decided, okay, I'm comfortable giving X number of dollars of my wealth into some structure that benefits my children, my family, whomever, my spouse even, right? That's a great kind of strategy to talk about. How then, now I've given it away, how do I undo it? Like, what does that look like, knowing that we have some changes coming up, to the point of not managing to a crystal ball, and to the point of not really letting the tax tail wag the dog, right? Which is what we as planners love to do. And we need to stop ourselves sometimes and say, oh, it's not always just about taxes. But it's actually about personal well-being, financial well-being, family peace, right? I mean, all these things. Talk to us about that kind of strategy where you're giving that away, and then what that look like to kind of create flexibility.
Absolutely, I'd be happy to. So you said, looking at certain examples, and what you had, your chart was really great, Karen. But let's talk about why somebody would gift, because let's see what they'd be leaving on the table and what's at stake for them if they don't do it. And then what happens, how do we minimize if we end up making an inadvertent gift, right? So right now we have an $11.7 million exemption. If the Biden proposal goes through and it drops down to 3.5 million, that difference is 8.2 million.
Yeah.
That they don't have anymore. And at a 45% tax rate, which is what they're talking about, you're talking 3.69 million that's left on the table. If it's a married couple, that's nearly $8 million left on the table by not gifting away their 11.7 million today. Yeah. That's a lot. That's significant. Try to get that rate of return on the brokerage account in a matter of a couple months, right? So
we just need GameStop.
That, Tesla, or Bitcoin, right? So what do? They say, okay, I want to give it because I don't want to leave 8 million. It's a couple, let's say. I don't want to leave table just based on timing of a tax law change. And we know, when listening to the prior session, the one thing I was thinking about is, we should all be investing in is the tax prep software companies, because there, every year there are so many significant changes going on, and I'm feeling very sorry for my accountant or any accountant that's going to have to be preparing these returns. So here we are saying, all right, the couple decides, look, we don't want to leave $8 million on the table. We'd rather it be in the hands of our children than with Uncle Sam trying to build infrastructure or whatever. So, or pay our debt, whatever. So what are the options? Well, one of the things is doing, playing with disclaimers.
Yeah.
So if you give the money to somebody, let's say a child, say we're giving you $8.7 million. But if they change the tax law, it would make a lot of sense, because otherwise we're going to have to dip, I'm going to have to dip in my pocket to pay this tax bill that's going to be quite significant. It would be really great if you, at that time, you make that decision, child, you disclaim. And when you disclaim, the assets don't go to you, it goes to somewhere else, either a GRAT or some other vehicle where it's not there's no gift. So, or there's no gift, significant gift. So
it becomes an incomplete gift.
Or make an incomplete gift. It could even, depending on if the asset, the disclaimer, it goes then to the spouse, to my spouse, and that qualifies for the marital deduction. So no gift, no problem. So that buys us 9 months of time. But again, you have to wait really until April to make that gift and have the disclaimer effective so that we don't run into other issues. So really, you can't really do it too much prematurely. You can't do it before April. Well, let's say you have a client who says, no, I don't want to wait till April. I know we're time's clipping away here, but what are some other opportunities? And you mentioned, Karen, about, doing a trust for a spouse, or, some refer to it as a spousal lifetime access trust with the acronym of a SLAT. We've been doing these for 35 years, all the different things back then.
So now we have a fancy name. So that's
now they have fancy names. And that's a really good mechanism because, again, it buys you time until, if you do an extension, October 15th, 2022, when you have to file the gift tax return on that gift to the SLAT. So you have quite a bit of time to make your decision. Me as the grantor, I can wait all the way up and guess what? It's up to me to make the decision. It's not up to my child to decide to disclaim, and maybe the child, doesn't want to do it at that particular time, and you can't have a quid pro quo. So maybe child changes her mind. But if I'm in control, I can elect to make a Q-tip election when I file that return by October 15th of 2022, and it has to be timely filed. There's no.
And that election, just back up there for a second, just to remind the audience of what that is. It's that qualified terminable interest property election, right, for marital gifts, right, to safeguard the credit.
Yes, but it's an election, a Q-tip election for qualified terminable interest property, which I don't have to make it, right? I can elect not to make it, and it's a completed gift. And then I lose my exemption amount. Or I can make the election because, let's say, they lowered the exemption amount down to 1 million, and it's like, I don't want to have a gift tax problem. So what I will do is I'll make the election, and it'll qualify for the marital deduction because it's going to my U.S. citizen spouse. So I'm in control, I'm in the driver's seat. But let's say I do make the gift is going to, it's in a Q-tip trust, it's in a SLAT. What about, can I do a reverse Q-tip and apply my GST exemption? There's so many things I can do. It's really nifty.
Yeah.
Not that many people do lifetime Q-tips, right? As a planning mechanism, they're not your everyday bread and butter, but they are very, very useful. The one downside, may I mention one downside? Okay, if you do a Q-tip, the income must go to the spouse. So you're going to have leakage. Those assets are coming back into the couple's estate because the income has to come back. But you, right, as the financial advisor, can basically manipulate the income.
Yeah.
In a sense, put it in long growth assets that's not producing a lot of income. We don't have dividends, don't have interest. It's just a buy and hold strategy or something along those lines. So you actually can control it, even though the income must go to the surviving spouse. And the surviving spouse can require that income, assets be in income producing property. But the other thing is, if let's say I get divorced, that the income still must go to my husband, even after a divorce, even after I die and he remarries. The income still has to go, but not the principal. You don't have to give any principal. You could say principal doesn't go to the spouse if he remarries. So there's so many things you can do with the Q-tip trust, with elections, no elections, terms that you put in there, and so forth. So I know I've done a lot of talking, so let me pause here and let you chime in for a bit.
Can I chime in for a bit? I have a question. So we're talking about, probably, if we were to categorize who we're talking about people that are probably over 11 million on each side. So maybe they have estates that are over $23 million. So these are techniques that are good for them. Well, what about, we might have people, I have clients who are in their 50s and they're in the accumulation stage. And so some of these techniques seem, number one, kind of aggressive to give money away. You're talking about bringing it back, but also I don't know how much I'm going to need. And I mean, I have kids that have launched and some are still in college. So what should I be doing right now as I accumulate my wealth and think forward? Because I don't want it to go to the IRS, but I do need to implement something, but I don't necessarily want to give it away.
Mm-hmm.
Well, one of those advantages of a SLAT is it's still available, number one, for the spouse, right? So they can access it. So you even though you've given it away, you have it as a couple, as a married couple, it's still within the community, if you will. The other thing is, you can put assets that, well, grats are great. So it's appreciation. So it's the freezing techniques, forget about tax law changes. Let's just talk about pure what makes sense for clients in that phase of life. So let's say they think, a particular asset is going to appreciate because, they're with a startup company or they're starting it and they'd like to get a little piece away just in case they hit a home run with it. Maybe they, whatever it might be. That's a very good technique to put it into a trust that the spouse can be the trustee of it. The spouse can be a beneficiary of it together with the children. So that's, there's so many different ways of doing that. If you're doing a completed gift, or you do this GRAT, a grantor retained annuity trust, where you put an asset into this kind of a trust and you get back the same amount of value as an annuity over whatever time period the grantor selects. So there's no real gift, because what you're putting in, you're getting back from a valuation perspective with the IRS. But what happens is, to the extent the asset, while it's in that GRAT, while it's in that trust, appreciates. So let's say there's a boost, a turbocharge in appreciation. It's GameStop, for example, and we done publicly traded securities. One doesn't have to have a startup to be doing this. The appreciation is captured outside, and it gets outside of the estate. So you can kind of find a happy medium based on the couple or the taxpayer or the client, if they're single, what makes sense for them. And it doesn't have to be for children, right? Maybe they don't have children, but whoever their beneficiaries are, or they say, look, I'd like to say where these assets go ultimately and not have it be, Uncle Sam determining this. So they have more of a say. So there are other strategies that we can do where they don't really give it away as much as, oh my gosh, I gave it away, I still get something back. And the other thing is a sale. They can sell to a trust, right? They can sell an asset. So they're going to hold a note, and they're going to get the interest income on that note. And eventually they're going to get back the corpus of the note, right? And so depending on where the client is in their wealth spectrum, they might really like the fact that the interest rate can be pegged very, very low right now. The applicable federal rate, depending on short-term, mid-term, or long-term loans, is really, really low, right?
It just basis points right now.
Yeah, I think it's like 0.56%, so less than 1%, 0.5% on a 9-year note for February AFR. So that's like nothing. But if the donor, the parent, says, look, I really want to have some income stream from this, I'm going to charge 4% on the note that I sold the stock for. So you can always go higher than the AFR. You just can't go under the AFR. So there are options here for them depending on their situation.
And those are so especially sorry, Barbara, that do cover not just the married family, but the unmarried, and which, not everybody's getting married these days, right? That rate's dropping. And so I like those as planning techniques for folks, the grantor retained annuity trusts, especially for folks that are not married, that have other people they want to scatter some of their assets to other kinds of other partners, which is really effective. But to the point, Barbara, on this kind of accumulation stage, because we work with, our clients, folks listening here today they represent all stages of life right now. And so we have folks that I call emerging professional accumulating wealth owners, aspiring to be the $11 million balance sheet, right? And then on the other end of that, now trying to make sure they can live off of what they have worked so hard over their lifetimes building, and then also benefit their family and or charities. And it's interesting, we have one question that came in as well that might, I think you hit on some of this, Lee, but is there a point in waiting till next year end to execute any tax? And I think you touched on that a little bit.
I can definitely address that, which is, if you want to take advantage, not leave $8 million on the table for Uncle Sam, for a
Yeah.
married couple or 4 million for a single individual, then yes, gift it away if you can afford to do so,
Mhm.
right? I mean, if you can't
Or
afford to do
and all of these too, these aren't all or none. Like you don't have to say, okay, I'm going to use all the exemption, but you could ring fence and protect some of it, right? And so that's to the point too, Barbara, that it meets, those are clients' needs that are still accumulating, but there's some certainty that it's going to grow exponentially in 10, 20 years because of who they are, what they're doing, how they're building. And I think, chipping away at the exemption while you have legislation that supports it always makes good sense. And you meet all of your other needs. Like we're back to Maslow's hierarchy, right? So, so that you're not feeling insecure and vulnerable for your own. You set someone else up, but now you're suffering, right? Which is curious. So it isn't an all or none. None of these strategies require 100% funding of your exemption amount, which is important to note.
What about, so let's say my primary beneficiary for my estate is really going to be charity. So honestly, I really don't care about the estate taxes because they're not going to be a factor here. So it's really giving to charity. So if I'm doing that, what are some of the things I should be concerned about or thinking about from that perspective?
Mm-hmm.
Well, I don't think eliminating a charitable deduction is in the cards for anyone's proposal. So I think that's a pretty safe bet, right? Marital deduction, I think, is a safe bet. Portability, likely a very safe bet. And charitable planning, still a safe bet. So, if that is the fact scenario, then yeah, grow it as much as, the client can grow it as much as possible. If it's all going to go to charity anyway, chances are there's not going to be any estate tax, right? Regardless of what the exemption amount is, regardless of what the amount is, which is sort of what, Warren Buffett is doing, right? As what he has voiced. And, he's, one of the things is, and I don't know if we'll have time to touch on this also, but, for clients, what should they be telling their children, what they're giving, what they're not? And Warren Buffett was very express about it. And, he has a very famous saying of, don't give a child, give them enough to do something with their lives, but not too much where they do nothing. So,
Right.
If everything's going to charity and only whatever the exemption amount is at the time of the death is going to family members, whether it's nieces and nephews or friends or the housekeeper, that's perfectly fine. And the rest goes to charity. There's not going to be any estate tax issues. So they're not going to have the same tax planning concerns, but they will have incapacity planning issues. Who's going to make decisions for them if they become incapacitated? During COVID, you can't imagine how many clients were saying, oh my gosh, with my advanced medical directive, if I'm put on a ventilator, did I say pull the plug? And things like that. So, to assuage their concerns, kind of going through those issues. But there's all those solid issues you still want to discuss with clients and have them plan for, even if it's not a tax-driven plan. It's incapacity planning. Should they have a revocable trust? Make sure they have, proper will. Make sure they, who are they selecting as their executors or their trustees, and so on and so forth. So the conversation shifts away from tax issues and more on these other issues that we also talk to even our tax planning clients about. So it's not unique.
It goes back to not letting the tax toe wag the dog. And a strategy I really like, to Barbara's question is especially in that stage of life where you are ready to just draw an income from your portfolio, that you're going to give away the bulk of your assets to charity in one form or another. But, create an income stream through a charitable trust and taking advantage of, some of that deductibility of that remainder interest that you're giving to the charity, but also improving and maintaining your cash flow stream. So from integrating your financial plan to also making sure that you're meeting some of your legacy goals. And I love that strategy and partnering that, even if you're charitable, to the point about, whether you become incapacitated, you are, slowly declining, and, cognitively, making sure that you set up someone in your circle, whether it's your family or close friends or whomever, to start to learn about that and advise on that. And I love partnering that with naming a charity, because one of the questions, I have actually experienced in the recent 2 years is, oftentimes a client thinks, oh, I have this 10 million, I don't, to the Warren Buffett's point, spare the rod, spoil the child, right? Then or my words, but his point, you end up thinking it's relative how much is too much to give to an heir, right? That's very personal, very relative. One child may think, I'm set for life with $1 million and do nothing, while another may feel vulnerable with as little as 10 million and still be very successful and go above and beyond that. And so communication and knowing your children, and kind of the beauty of the seat we sit in is we oftentimes get to know the whole family, and we work with different branches of the family, different generations of the family. And you can kind of start to inform a strategy, not based on amount, but based on who are the recipients, who are the actors in this idea, right? And that's less of a tax conversation and more of, am I legally bound to give them information as to what I'm funding that trust for their benefit of? And that's an ongoing conversation. I've had a client where, well, I trust daughter, I don't trust son to know, right? And even have competing interests inside of a family and facilitating that. But setting up, where let's say in the example of a charitable bequest, I'm going to give all of my wealth to one charity. I spend a lot of time in the philanthropic sector in the community. It makes up a huge part of our workforce from a GDP contribution perspective, but in a size per entity on smaller scales. Well, many are crippled with receiving a gift of $10 million, right? So really understanding who you're landing that kind of wealth on as a charitable recipient. And do they have the organizational infrastructure to deal with it? You don't know that answer if it's down the road when you die. So I really love the idea of incorporating a donor advised fund to be flexible, to provide flexibility in that example, so that the heirs can pivot. The new advisors of the charitable bequest can kind of pivot quickly. Oh, that one's gone out. That mom named that charity, and now they're bankrupt and they're done. Then what, right? And that's a common charitable giving problem that's part of the estate management process.
Although on the drafting piece of that, as a drafting attorney, we always put in what's called the misnamed charity clause, or if the charity doesn't exist or loses its tax exempt status, that the executor or trustee, whoever's administering the funds at that point, can select another charity that's similar in purpose to carry out the charitable bequest.
And it's so important, so important. I've seen that too often.
So I'd like to shift gears a little bit and talk about, so we are talking about moving money to the next generation and the generation after that. And if we think about it, if we think, well, here's the grandparents and they've set up trusts for the grandkids, and then the parents come along and set up trusts for the grandkids, and you look at one person, they might be receiving 6 trusts, right? You look at one person, the grandchild has 6 trusts coming at them from different places. So how do you manage that? Because to me, that seems like an administrative nightmare. And, I have a lot of money, but it's in all these different trusts and I don't know how they operate. So how do you address that when you're drafting, or if you actually have a client that's in that situation?
Yes, well, most trusts do, I put this in my trusts, but then even in certain states have it by statute, where you can merge trusts that have substantially similar terms, so that you can merge them and administer them as one single trust of sorts. The other thing, talking about, okay, there's 6 different trusts. Yes, would it be economies of scale if you had one account being managed where you're pooling all those funds? You could have those funds, each of those 6 trusts, basically contribute into, let's say, a limited liability company, and then open up one account in the name of the limited liability company, and the manager of that limited liability company, could be the trustee too, is administering it as one pooled fund, and then just getting K1s out to the six trusts. But yes, each of the 6 trusts will have, for example, a 1041 or a fiduciary income tax return due, and giving a K1 to the beneficiaries if the income is being passed out. So yes, it can get complex, and depending on when the trusts were set up and by whom, you may not be able to merge them. I mean, you may be able to, but you may choose not to, because you may then blow the GST election or a longer election period, or you may blow the rule against perpetuities issue. You can't go from one that was perpetuities, where you had a time limitation where a trust could only go, let's say, 120 years or 90 years or whatever it is, depending on where it was set up. And now you want to have it in, state X that has an unlimited rule against perpetuities, and you can make it go forever. You say, wow, I like the forever versus it's going to terminate when this person dies or 30 years after this person dies, and we're almost there. He's 85 years old, he's 90 years old. What are we going to do then? You can't just put it into the longer term, decant it into the longer term trust. So you have to be careful. So in theory, you've identified the problem, Barbara, and it is a problem for some who are so lucky to have very, parents and grandparents that are bestowing all these assets to them in trust. And there's also provisions in most states also, and in most trusts, that if it's uneconomical to administer, so let's say one of those 6 trusts, only has X dollars in it, and it's not economically viable to keep this whole trust going, filing the returns and all that, they can probably find a way to either decant it into the other trusts or to distribute it out to the beneficiary, if it's a small enough amount or what have you. So we often run across those issues. So Barbara, thank you for flagging it, because it is something that does arise, but sometimes the solution is worse than the having the
Well, and that's so funny because we hear that often. It's so, the complexity is keeping lots of professionals employed, right? Like who's winning when you're creating so many structures to kind of serve the tax code, serve this, and you do. It's a kind of a dance in optimizing. Like, okay, these are the must-haves. This is really nice to have, but it's going to cause this much in administrative pain, this much in additional legal or accounting fees. Because to the point of, as financial planners, one of the great things we provide to our clients is we'll kind of pull all those silos of money together, right? And can think about investing in an asset location kind of idea. So which kinds of assets that are income or growth oriented should live in that either tax penalty kind of structure, like a trust. Sometimes it's an irrevocable trust that's not very friendly on income tax whatsoever. And being kind when I say not very friendly. And to how do I kind of shift that to other beneficiaries and manage assets, dovetailing the asset management into what do each of those tax entities really look like. And so simplicity is king, right? So our clients are like, I need this to be simple. I'm like, their bandwidth is spent. They've grown their wealth. They've had their careers. And there's a little bit of mental relaxation that needs to happen right at the time we're introducing the most complex kinds of things into their lives. And so,
right. So Karen,
oh, sorry.
Okay. What I was going to say is, Karen, one of the things that you touched on was involving other people in your estate plan, right? We're talking to multi-generations. And if you think, if Lee's working and developing a plan for the grandparents, and they have specific goals, but then they have adult children who will also inherit wealth and be earning their own wealth. And so it seems to me coordinating these plans together is helpful for the ultimate beneficiaries, whether it's the second generation or beyond. So how do you have that conversation with the different generations, and when is it appropriate? And to what degree do you sort of show them the book and where everything is?
And should you ever show them the book?
Good question. Yeah.
I think in some cases the answer truly is no. And I've been so I've had an interesting career that has spanned all kinds of families of varying wealth degrees, right? And so coming out of big family office where you're looking at hundreds of people that are part of the same family, and having a conversation doesn't always. What I've always come to the family conversation once the planning is okay, we've organized these ideas, we've had Lee in to kind of talk about the legal specifics and the logistics of how this gets rolled out. Now let's talk about the people that it impacts and bring those individuals into the conversation. And I've always done that with less of a focus on, or even conversation around the dollar amounts, and more so about the materiality of it. So you have a responsibility. There's if you're an heir, having a conversation and coaching a parent on a conversation around responsibility and stewardship, more so than, hey, don't screw this up, Johnny, with this X million of dollars, right? So my approach has always been on the positive outlook of what's possible with good behavior. And I'd be curious to hear, and that's been well received. And then the conversation starts to move away from, well, I must know, but okay, it's significant enough to have a conversation about. So there must be something there. And eventually, depending on the time length involved or the participants involved, you can start to unveil whether it's a certain asset that is part of it. Hey, it's a closely held business, or it's an LLC, or it's any number of things, a publicly traded portfolio. And that can all kind of cascade out over time. But I think intentionality is important, and stewardship is important, and your responsibility in your family system is important. So I personally come at it from that way, and that's been pretty successful. And then there's the conversation that is on Lee's side of the table that, okay, here's what you're legally bound to have to share and not, right? You can, and that's a different conversation. That, okay, as long as I'm operating within disclosures of the trust laws that are in place to protect both parties, right, beneficiaries, so that they know what their rights to claiming anything are. A lot of those regulations are around information sharing, but not everything, right, Lee? So I think that's a different conversation.
Yes, and I think what you're touching on here, Karen, is it's really important to build that flexibility into the plan, because things could change, and irrevocable is, we say there's back doors out of irrevocability, and there are sort of trap doors. You can kind of get around it, even if it says irrevocable on the front cover of the first cover page of the trust. But with that, there was it was an article, and it was, to tell or not to tell your children about the estate plan. And there's pros and cons for that. So, and I've seen it played out both ways. So, for example, what a child doesn't know sometimes could help them if they don't know, okay, I might have an expectancy, because they might change their behavior to the negative if they think, oh my gosh, I'm going to ultimately have this wad of cash. Ultimately, I'm a beneficiary of it. So I can take more risks in my business ventures, right, that I otherwise wouldn't have done if I didn't have that to fall back on. And others may say, oh gosh, I have that. I can basically do nothing because I've got that to fall back on. So, it impacts it. And there's the concept of the silent trust. So, that certain states have silent trust legislation, like Delaware is one. So it permits trusts to remain silent for beneficiaries even after they've reached the age of majority, under certain circumstances. There still has to be somebody who's receiving notices and can oversee that the trustee is doing the job properly on behalf of the beneficiary. But the 21-year-old kid that's still in his second year of vocational school or whatever is not quite taking a longer time. Maybe it wouldn't be helpful for him to know about this trust. It could be delayed, letting him know about it. The other aspect, as I know we're going to be running out of time quickly, but I just want to mention again on trusts, you can, number one, have flexibility in terms of, what is shared with them or not. But it's very important to know that those assets also, by and large, can be drafted so they are asset protected. So they're not subject to the beneficiary's claims of creditors. So if that child who ended up taking a lot of risk in business because knew that there was a trust here to be able to fall back on, went too risky, guaranteed a bunch of business loans, the company went belly up, and now he's got debts up the yin-yang. What's going to happen now? Well, or what about the one who—
Or divorce.
Got married, in the prenup, right? What if they don't have a prenup? They don't want to have a prenup. I'm not going to bring up a prenup. That's the first thing that will crush, a relationship. I'm not going to bring it up. And therefore, well, assets in a trust are in a type of prenup in a sense, because they're assets that can be isolated and kept safe from, in certain states, not every state, from the claims of an ex-spouse. So there's many features to that are very helpful.
Yeah, I know that, and it's so important to because there's layers of flexibility, right? So it's not just in structuring things. Like the takeaway there is not just the solving that I might have over gifted, flexibility there, but solving also for who needs to know and creating flexibility there, and then solving for how I own those assets so that I can make sure that I'm protecting whomever I'm giving them to from other undue influences. And I mean, I think about the estate planning world really in that, with those three things in mind all the time. And we had a question come in through the Q&A back. I didn't want to kind of blow past that question because it's an important one, and it gets at a really interesting intersection between the financial planning conversation that we're having on a daily basis and cash flow, and kind of really appreciating what tax brackets I'm going to manipulate from year to year, and to charitable giving. So the question is addressing RMD charitable giving, and can you rescind? Is there an opportunity to rescind that qualify? And those RMDs are known as qualified charitable distributions, so QCDs in this case. And can you rescind those gifts? That might be where there's not the same kind of flexibility is the, is the short answer.
Right. And for rescission, generally you have to have mistake of fact.
Yeah.
Or Scrivener's error. Scrivener error is the easiest thing to do. But when we're talking in these concepts, to rescind a gift might be a little more difficult, unless, the question is, well, is change of a tax law something that is one of the reasons you can have a rescission because of change, because of mistake of fact, that type of thing. So, but rescinding a completed gift is a little tricky.
That's right. And I will also add, just on the planning side, because we're just kind of at an anecdotal level, we're seeing a reduction in charity being kind of carried out in certain plans. And so that's interesting. And trying to figure out, why that's happening. Is it the idea that there's enough stimulus going in support of that sector that we don't have that same level of responsibility that's driving that, or is it that we are so overwhelmed by uncertainty in the tax code that's driving that? And it's probably a mixture of both, really, at the end of the day. But what's interesting is, even you're giving funds to a charity, and whether they're coming from your IRA, which is a great source, by the way, for those gifts to come from, because those come out to you, as you all know, as ordinary income tax distributions. So in an increasing income tax environment, that's likely still a good decision. The other side of that is the charitable recipient side, right? So rescinding a gift means someone doesn't get it anymore. And someone that depended on that gift, especially a charity more than others, and if it were to satisfy a pledge, either directly or indirectly, could have some other unintended consequences. And so that might not be worth rescinding that gift to kind of pull that back if the fear was really insecurity around cash flow and other asset building. To get you through to those final years. Hopefully that addresses that question, but it's complicated.
It is, although there are many charitable options, outright gifts, charitable lead trusts, charitable remainder trust. I mean, I think it was Jacqueline Kennedy Onassis who was queen of using CLATs, charitable lead annuity trust, and then once everybody found out she did that, everybody was clamoring to do a CLAT. So they're like, well, she did it. That sounds like a really good idea. No, she did very sophisticated tax planning.
That's right.
But, I think also because many, I don't want to say all, of course not all, but some charitable giving is the tax advantage is one of the reasons some taxpayers engage in it. right? They do it because they're going to get either a current income tax deduction, it's going to offset some of the other income they're going to have that year, or gains, or ultimately, to have a, state tax exemption. With the higher exclusion amount being at the 11 million or 23 million per couple, right? If we look at, well, how many people are going to be exposed to an actual estate tax? It's very little, right? Statistically, I mean, those that are in the top, what percent of the country's wealth, and therefore maybe they don't have the same motivation from a tax perspective. So they're going to be doing it for other reasons because, that cause is very important to them. And so they're going to do it anyway, regardless of the tax situation. But you're still going to have a subset where one of the motivations may be tax, and if there's no tax incentive for them, they're not going to really do it.
That's right, and that still polls fortunately. It's true though, and I think there's a good poll around that, like what's driving your giving behavior, and that comes overwhelmingly above 70% are tax driven in that, and that's and it speaks to both sides of IRA being allowed when the tax law changed to allow for that distribution to come out of the IRA and then qualify for the gift. You're getting the benefit of moving that off of your estate, so you don't need to do other estate planning. I love the strategy, by the way, and use it often. And then you're also reducing over here this income tax side that's really heavy and punitive and likely set to go up. So that's still, that planning to me will make sense as long as the ordinary income tax rates are higher than capital gains tax rates that you would otherwise hold those assets in. And so.
Right. I think also what we're hearing from our clients and then the prior two sessions is tax planning is like an annual decision in that, we can decide that year to give to charity and how much to give to charity. When you hire an estate planning attorney and you get your documents drafted, that seems more finite. And if you set in, so that decision, oftentimes you don't want to undo it on a regular basis. And so maybe people are more hesitant to be more aggressive on the estate planning side with charity with regard to that decision versus on the tax planning side. But I think we've talked about a lot of different topics here, and there's a lot of takeaways. But maybe, Karen, you can give us the top 3 takeaways you think we should remember from this conversation.
I do, and this area is so nuanced, right? As you can hear, you can go down lots of rabbit holes, but what I think you should think about, and especially in your partnership with us and your partnership with Lee and attorneys like Lee, is that you should always do something. Now is always the time, because while we've been talking about taxes as to timing when we take action, we are still organic creatures, and the proverbial bus may hit us. Right. So now is always the time to have intentions known about how you want to share your wealth, and that plans can be flexible. Number 2. So there's lots of ways to create flexibility, even when you have these heavy terms like irrevocable that seem finite. And then that you have a partner. So you have a partner in SBSB, you have a partner in McDermott, Will & Emery, and other firms of your choosing. But you have a partner to kind of navigate this complex space with. And we hope that you learned something today, but more importantly, that it opens up some dialogue and engages us to kind of work with you to kind of execute certain ideas. So thank you for joining us today. Thank you, Lee, for being a partner with us in this.
Thank you, Lee.
Thank you for inviting me.
Thank you, Barbara.
Yes, thank you.